So I'm originally from North Carolina. Went to school here in Nashville. Got out of school, ended up moving down to Alabama for about 3 years. Worked for the city down there as a firefighter. Kind of knew throughout college, I wanted to, do something kind of fun, kind of adventurous. Jumped into the world of firefighting. Spent about 3 years down there as a firefighter. And then I moved back up to Nashville about probably going on about 5 years ago now. I still actually, I don't tell a lot of people this, but I still have my job as a firefighter. It's a W-2 job. It's very stable income. Our schedule, we work 48 hours. So we work a 48-hour shift and then we're off for 4 days. So it's very conducive to, to real estate investing, to trying to build a portfolio and, really just analyze properties. I could go up to Gatlinburg with Felipe the other day and kind of look at the property we were buying. But it's also very conducive to, having a side hustle that's in real estate. So that's kind of where I got into mortgages. I had a former coworker who was a loan officer. And we came in one day, I think it was a Monday morning, came in, just shooting the breeze, asked him about his weekend. And he basically told me, he said, man, I was working all weekend, but the good part of it was I was in the middle of the lake sitting on my boat. So of course that kind of piqued my interest. I had to, find out a little bit more about that and kind of what he was doing. Always knew I wanted to get into real estate, knew it was kind of hard to be a real estate agent, just with the job I have, especially, as you guys all know, just how hot the market is right now. It's, if I'm on shift for, another 47 hours and somebody calls and needs to see a property, they're going to either lose the deal because they're not going to be able to see it in time, or B, they're going to go somewhere else and basically find an agent who can show it to them. So kind of knew that wasn't going to be the route for me. And just talking again with my former coworker, knew I've always kind of been financially minded, love spreadsheets, numbers, all that kind of stuff, investing. And so yeah, ended up jumping into mortgages about 3 or 3.5 years ago now. It kind of started out as my side hustle, as a way to, kind of network with people in the real estate space, kind of build some of that synergy, and also, learn enough that I could invest as well, while at the same time making enough money. As a firefighter, we're not making a whole lot. So making enough money to really be able to pour into real estate. So it started as my side hustle about 3 years ago. I think the first year I was in it, I don't think I made a single penny. And now it's gotten to the point where it's much, much more than what I'm making at the fire station. So at this point, I'm just kind of keeping my fire station job just because it is a little bit of extra income. It does help us qualify for more properties. And I can still work the mortgage job at the station. I basically come in, check the trucks off, and then set up my computer in the corner and just kind of go to work. So that has allowed us the opportunity to, my wife and I, to purchase our first rental property last year. So we bought just a little 3.2 $90,000 house just across the border into Kentucky. So if anybody else kind of knows Tennessee or is from Tennessee here, it's just outside of Clarksville, Tennessee, was where we bought our first one. And from there just got into the short-term rental space in Gatlinburg. So yeah, it's really crazy just kind of how your mindset grows and evolves after, you get into this game or you buy a deal or, you start growing. I'm sure a lot of you guys can attest that as you're growing, your mindset is just constantly evolving. So we bought that first property, and that, $90,000 purchase was pretty scary. But a couple months later, we dove into Gatlinburg and bought a, $500,000 cabin, which was terrifying. So really cool to kind of see that grow and scale. And that's, as Felipe said, that's how we kind of connected. He was thinking about the Gatlinburg market for a little bit. And so we kind of connected, after I denied him for the loan, connected and started really talking more about Gatlinburg. So that's a little bit about me, kind of where we're at. We've got 2 properties right now, the long term and then the short term in Gatlinburg. And then as Felipe said, we're closing on, what will be for me, our 3rd property here in about 2 or 3 weeks. So that's a little bit about me. Do you guys want to ask questions? Do you want me just to kind of dive into the loan stuff, or what are you guys looking for?
Would you mind talking a little more about the inside of the lending? What are the right questions people should be asking? What documents they should go ahead and have ready and things like that?
Yeah, absolutely. So for us as investors, I'm sure a lot of people here know that obviously the more you grow, the more you scale, the more properties you get. the more intensive it gets in terms of the documents that you need, the things that a lender is going to ask you for. So from a documentation standpoint, if you have a W-2 job, you're going to need all those documents to basically show, your W-2 or your commission job, wherever you work. We're going to need to verify that. So that's going to be 30 days of pay stubs, your last 2 years of W-2s, your last 2 years of tax returns. And then typically you want to see 30 days of bank statements to see where the money from the down payment is coming from. From an investor standpoint, if you have, 4, 5, 6, basically more than one property, even if you just own a primary residence, we're going to need the documents for every single property that you own. And Felipe can obviously attest to this. It was a little intensive when we kind of talked, and I think I had to come back to you once or twice and say, hey man, you've got this property, we need X on this property. So for each property, we're going to need your mortgage statement. We're going to need your HOA bill if you have one, and if not, we're going to just have you write a letter that says, hey, this property has no HOA dues. We're going to need your insurance policies on every property, and we're going to need to see the tax bill on every property. What is your tax bill? Is it paid? How much is it? And then we're also going to need to see if those properties have already been leased out. We're going to need to see those leases. We typically like to see 12-month leases to be able to use some of that income. And then we're also going to need to see if you've sold any properties lately that could potentially show up on your credit report as a property that you used to own. We're going to want to see the documents from the title company, the closing documents from when you sold that property as well. So obviously, if you own a bunch of properties, that can get a little bit intensive. But those are typically the documents we need. In terms of, and I can't remember if you asked this or not, so stop me if I'm skipping ahead, but in terms of calculating the rental income, what we're going to kind of look for, if you have a new property that you just bought, as long as you have a current lease on it, like I said, typically 12 months, a 12-month tenant in place, we can use that gross rent, and then we'll multiply it by 75%. And then we can use that to hopefully offset some of the mortgage payment on that property. So for instance, if you bought a property last month, and then you come to me or you go to your lender to buy a property this month, as long as you have that lease in place, there's no kind of seasoning period, no kind of period where you have to actually collect those rents. As long as you have that lease in place, the lender is probably going to allow you to use 75% of the gross rent to go ahead and offset that for your next purchase. Now, the other side of that where it gets fun is if you're buying a property, and if you have a primary residence and you have 1 year of management experience managing properties, if you're going to buy a property and your current income does not support or is not high enough to be able to support a new investment property, we can take the projected rent on that new property and use that to help offset that, help qualify you as well. So say you come to me, and you're kind of right at that threshold of debt to income being a little too high, and you want to buy a property that we think is going to rent for $1,000 a month. What we'll do is we'll have the appraiser go out there, and the appraiser is going to fill out a form called a 1007 form typically. That's going to have what he thinks the market rent for that property will be. And then, like I said, if it comes back at $1,000 a month that the appraiser thinks that property will rent for, we can take 75% of that and use that to qualify for that subject property. So that's a little bit about how it works. If you have a property that you've bought and you've held it, say you bought it last year, you filed taxes on it this year, at that point, the way we're going to calculate income is we're going to calculate it directly off of your Schedule E. So this is where it gets really important. And your CPA is going to tell you something different because your CPA is trying to save you money on your taxes. I'm trying to help you get more money. So as you start acquiring properties and getting more, you want to start showing a little bit of income on each property to offset your debt to income limits. So basically, if you show a loss on, you've got 4 rental properties and you show a loss for each property, that's probably really going to negatively affect you in trying to qualify for another property. So there are a few things that we can add back into what's on your Schedule E. So if you claim a $500 loss per property, we can add a few things back in, like we can add back in the HOA dues and the insurance and the taxes, because you're going to get hit with that on your mortgage payment anyway. And so we don't want to double hit you. Any depreciation that you've taken, we can add that back in. But any big expenses that, I think I'm muting myself. Any big expenses that you've had on that property that you're wanting to count against that property's income and show as a loss, that's going to negatively affect you when you go to qualify for the next property. So it may and it's kind of just up to you and your goals and where you're at, what you're looking to do. But like I said, it's going to probably help you save a little bit of money on your taxes by showing a loss. But just kind of keep in mind when you go to apply for a loan, you got a bunch of properties and they're all showing negative cash flow, and your income is not strong enough to support all the properties plus the new property you want to buy. At that point, it's going to affect you from a mortgage standpoint. So